boy. So let's get into this. Have you noticed how the cost of pretty much everything seems to be going up, right? We all feel it. But what if like one hidden cost, something baked into prices when you use a card, what if that's about to be challenged by like the biggest companies out there? Yeah, I'm talking about giants like Walmart and Amazon. So today we're doing a deep dive. We've got these reports suggesting these huge retailers are seriously looking into creating their own digital money, stablecoins specifically. And we've got this really detailed analysis, our source material here. It breaks down exactly why they do this. And spoiler, it involves massive amounts of money. It also talks about how they might use blockchain in these stablecoins, what the roadblocks might be, especially regulation from DC. And importantly, who else gets hit by this? So our mission, let's unpack it. Understand the money involved, how it could change, where your money lives, how you spend it, and the ripples across the whole financial system. This report's going to guide us.
Yeah, and it's crucial to get this from the start. The report really doesn't mince words. It calls this move by retailers the most significant and credible structural threat to the card payment system in, well, a generation. This isn't just tweaking things. It's potentially a tectonic shift.
A tectonic shift. Wow. Okay, if it's that big, let's figure out what it's shifting. You said money's the driver.
Absolutely. The core why is definitely the money retailers are paying just so you can use your card. The report's blunt. Calls the current system basically a mandatory non-negotiable tax on them.
A tax every time I swipe.
Pretty much, yeah. And to get that tax, you got to picture the standard setup, right? The four-party model. Sounds complicated, but it's just the players.
Yeah.
You, the cardholder, the store, the merchant.
Yeah.
Then the store's bank, that's the acquiring bank, and your card's bank, the issuing bank. And then, Visa and MasterCard are kind of sitting in the middle, connecting it all up.
Right, like the orchestrators.
Exactly. So you swipe, the merchant pays a fee to their bank. A big slice of that fee, often the biggest, is the interchange fee. That goes from the merchant's bank to your card's bank. But here's the kicker. The rate, that interchange fee level, that's largely set by the networks. Visa, MasterCard. And the numbers, they're just staggering. In 2024, U.S. interchange fees hit $148.5 billion. A record. The report estimates this gets passed on to us, consumers. Works out to almost $1,200 per Family every year, just baked into higher prices.
$1,200 a family just for card fees. That's a lot. And it's not simple, is it? The report calls it a labyrinthine structure. Hundreds of rates.
So incredibly complex. It's not just one fee. The rate depends on like a ton of factors. The source breaks it down. Card type, for instance, debit's usually lowest, right? Yeah. Lower risk, credit cards are higher. And then those fancy rewards cards, the Visa Signature, MasterCard World Elite. The one's getting you points.
Yeah, I've got one of those.
Right. Well, they have the highest interchange fees. That revenue stream helps pay for those points you're collecting.
Ah, okay. So my travel points are linked to the store's fee. Interesting.
Exactly. And transaction type matters too.
Yeah.
Card present, like in a physical store. Lower risk, lower fee, usually. But online shopping, card not present. That's huge for Amazon, obviously. Higher fraud risk, perceived risk anyway, so the fees are much higher. And there's other stuff too, like the merchant category code that's like a risk profile for the business type, and even the transaction size. It's often a percentage plus a little fixed fee.
So the retailers, they're stuck with this complex, costly system, and the report says they feel like they have zero leverage, can't negotiate this biggest cost, just a pass-through expense.
That's exactly it. And, there's been some regulation in the U.S., like the Durbin Amendment. It capped debit fees for bigger banks, around 21 cents plus 0.05%, maybe going lower soon. But crucially, Durbin doesn't touch credit cards. And if you look at, say, the EU, they have strict caps. 0.2% for debit, 0.3% for credit. So you can see why U.S. retailers feel like they're paying way more.
Right, they see a precedent elsewhere. Okay, so the pain point is clear. Massive fees, no control. But let's scale this up for Walmart and Amazon. This is where the rebellion idea really clicks, huh?
Absolutely. I mean, these are two of the biggest companies on earth. Walmart, FY23 revenue, over $611 billion total. About $421 billion just in the U.S. Amazon. Nearly $575 billion total net sales, $353 billion in North America. Between them, that's over $1.18 trillion in revenue. Huge numbers. Now, the report makes some educated guesses, like maybe 70% of Walmart's U.S. sales are card-based. For Amazon, maybe 95% of product sales because they're so online.
Yeah.
You apply those blended interchange rates we talked about and the estimated cost, it's mind-blowing. The report pegs Walmart's annual interchange bill at roughly $6.9 billion.
6.9 billion just
Yeah.
in fees.
Just in interchange fees, yeah.
Sure.
And Amazon, because so much is online, higher fees, rewards cards, their estimate is even higher, around $9.6 billion.
Okay, wait, so between just Walmart and Amazon, they're shelling out over $16 billion a year in these swipe fees. That's
Yeah,
that's almost unbelievable.
it's staggering. And the report puts it in context. For Walmart, that's $6.9 billion. It's over a third, 33% of their entire U.S. operating income, gone to fees. For Amazon, the $9.6 billion. That's over 64% of their North America operating income. 64%.
Okay, yeah, that's not just an expense anymore. That's almost existential for their profit margins. The report calls finding savings here a strategic asset.
Exactly right. Think about freeing up billions. They could slash prices to undercut competitors like Target or Kroger, who are still paying those fees. Or they could pour it into logistics, tech, new ventures. It's a massive competitive weapon. And here's another angle. They could potentially flip this, turn this cost center into a profit center. Imagine they build their own payment rail. They could offer it to all the third-party sellers on their marketplaces, right? Millions of them on Amazon. They could charge those sellers less than Visa, MasterCard, so it's attractive, but still make a profit themselves. It creates new revenue, locks sellers in tighter. The goal, the report says, is to capture and control the payment rail.
Okay, the why is crystal clear now. Billions of dollars and strategic control. So let's move to the how. The report singles out stablecoins as the tech. How would that work? What kind of stablecoin are we talking about?
Right, so stablecoins, they're a type of digital currency on a blockchain. But unlike Bitcoin, they're designed to hold a stable value. The specific type they're looking at here and what the regulations focus on is fully collateralized, fiat-backed.
Meaning pegged one-to-one with, like, the U.S. dollar?
Exactly. So for every digital Walmart coin, or whatever they call it, they'd hold one actual U.S. dollar or something super safe and liquid like a short-term treasury bill in a reserve account. And that reserve would have to be audited, for transparency. Now, picture the payment flow. It gets way simpler than that four-party mess. First, you, the customer, you need to on-ramp dollars into the retailer's app. So you link your bank, move maybe $50 into your Walmart app. Walmart then issues you 50 Walmart coins. That $50 leaves your bank, goes into Walmart's stablecoin reserve. Then, at checkout online, or maybe using a QR code in the store, you just pay straight from that app wallet. The stablecoins zip over to the retailer's wallet on the blockchain.
And the big wins there are speed and cost, right? No middleman fees.
Precisely. Settlement is near instant. Minutes, seconds even, versus days for cards. Huge cash flow boost for the retailer. And yeah, like the report says, it disintermediates the card networks and those banks. No interchange fees. Gone. They could even use, like, smart contracts. Code on the blockchain to automate things like authorization, capture for online orders, mimicking the current process but without the fees.
Okay, but getting millions of us to actually use this, that sounds like a massive uphill battle. How do they pull that off?
Well, that's where they have a huge edge, right? They're not starting from scratch. They already have apps on hundreds of millions of phones. People already use them, maybe have payment info saved. They could just embed this new payment option right in there. And the hook, it's simple. Save money. They could literally offer, say, save 2% instantly when you pay with Walmart coin, funded by the billions they're saving on interchange. The report mentions the Starbucks app, right? They built a huge payment system just by making it easy in their app and offering small rewards. Walmart and Amazon could do that, but potentially way bigger. But, and this is really critical, but the report stresses this whole grand plan. It absolutely hinges on the passage of a favorable federal regulatory framework in the U.S. Without clear rules, it's all just talk. Which brings us to the legislation being debated. Things like the Guiding and Establishing National Innovation for U.S. Stablecoins Act, the Genius Act in the Senate, and the Clarity for Payment Stablecoins Act over in the House. These are key.
So these bills are basically trying to make it legal and provide clear rules for this kind of digital dollar to operate.
That's the core idea, yeah. Create a clear legal path, a federal charter for stablecoin issuers. That would override the messy patchwork of state laws and bring stablecoins into the regulated financial system, give them legitimacy. And the source dives into the details. They define what a payment stablecoin is pegged to fiat, redeemable for dollars, and, crucially, not a security. That keeps the SEC out of it mostly. The big thing for retailers, these bills create a way for permitted payment stablecoin issuers to include non-bank companies, like Walmart or Amazon, via a special federal charter. That's their potential route in. Banks could do it too, of course. And there are prudential guardrails proposed, strict rules, like holding 1.1 reserves in safe stuff cash, treasuries, transparency, audits, clear rights for you to get your dollars back, and limits they can't, like gamble with the reserves.
Sounds like a fight in Washington, though. I imagine not everyone's thrilled.
Oh, absolutely. It's a major political battle. You've got proponents saying, this boosts innovation, keeps the dollar dominant digitally, protects consumers by regulating this space. But then you have opponents, and the report mentions figures like Senator Elizabeth Warren raising big concerns. Is it too permissive? Could letting non-banks issue private money destabilize finance? Are consumers really protected enough? Illicit finance risks? And this underlying worry about concentrating immense financial power in the hands of big tech or these giant retailers, it's more than just crypto regulation, really. The report frames it almost as a proxy war over the very definition of banking. Are we creating a new type of narrow bank just for payments outside the traditional system?
Okay, so while Walmart and Amazon are strategizing this potential bypass, what about the old guard, Visa, MasterCard, Amex? Are they just watching? The report says incumbents are not passive victims.
Definitely not passive. Yeah. No, their response is pretty smart, actually. They're not trying to kill the tech. They're trying to integrate with it, repositioning themselves, from just running the network to being interoperability service providers. Right. Take Visa. The report calls their strategy becoming the bridge. They're actually using stablecoins like USDC on blockchains like Solana themselves behind the scenes to speed up settlements between banks. Settled over $225 million that way already.
Huh. So they're using the tech internally, maybe co-opting it a bit?
Kind of, yeah. And they're focused hard on the on-ramps and off-ramps, where regular money meets crypto and back again. They've handled billions of people buying crypto with Visa cards. That's the on-ramp. And billions being spent from crypto balances via Visa cards, the off-ramp. They're partnering with companies like Bridge, which is part of Stripe, for Visa cards linked right to stablecoin balances. Spend your stablecoins anywhere Visa works. And they're selling tools. Their VT Pay service lets banks issue their own stablecoins, with Visa providing the tech underneath. They profit either way. MasterCard. Similar playbook called Building the Ecosystem. Tons of partnerships. Exchanges like Kraken, Gemini, Binance, wallets like MetaMask, linking crypto to MasterCard. They're trying to make it easier, too, developing stuff like MasterCard Crypto Credential to make wallet addresses less clunky, more like Venmo, and building new networks themselves, like the MasterCard Multi-Token Network, MTN. Big banks like JP Morgan are already plugged in. They're also letting merchants get paid directly in stablecoins like USDC. American Express is a bit more cautious, brand-centric, according to the report. They've got that co-branded card with Coinbase, offering crypto rewards, targeting crypto users, but kind of outsourcing the direct handling.
Right. So the incumbents aren't getting totally cut out. They're trying to become the essential plumbing, maybe, connecting all these different pipes, even the retailers' new ones, and taking a little fee for the connection.
That's a good way to put it. Yeah. They want to provide services, conversion, security, identity that are needed no matter which rail the payment travels on, shifting from owning the highway to managing all the interchanges. But if we zoom out again, this whole potential shift, it's not just retailer versus the card network. If these retailer stablecoins really take off, the report warns about serious systemic shockwaves across the entire U.S. financial system. And one group highlighted as facing potentially existential risk, community banks, from something called deposit disintermediation.
Deposit disintermediation. Okay, what's that mean for my local bank down the street?
Okay, so follow the money. You decide to use the Walmart app to get that 2% discount. You move $100 from your checking account at, say, Main Street Community Bank into your Walmart coin wallet. That $100 deposit, it just left Main Street Bank's balance sheet. They lost that funding. Now, Walmart, the stablecoin issuer, has that $100 reserve. But are they going to keep it at Main Street Bank? No. For efficiency, they'll pool billions, maybe trillions of these reserve dollars into huge accounts at one or two giant custody banks. Think BNY Mellon, JP Morgan Chase. That money doesn't flow back to the thousands of community banks it came from. The report calls it a slow structural drain, a bank walk, siphoning deposits from local banks into the biggest money center banks. And why that matters is community banks rely heavily on those local deposits. That's their cheap funding source to make loans in their community mortgages, small business loans, farm loans. If those deposits dry up, their funding costs go up. They might have to borrow more expensively. That squeezes their profits and makes it harder for them to lend locally. It introduces this national funding risk they can't control, which the report argues is different, maybe more insidious, than the usual local credit risk they manage.
Okay, that makes sense why banking groups, especially the community bank ones like ICBA, are lobbying hard for rules in stablecoin bills, like maybe prohibiting stablecoins from paying interest so they don't directly compete for savings.
Exactly. And beyond community banks, there are broader systemic risks, the report flags, if these huge non-banks start issuing what's effectively private money. Like run risk. What if people suddenly doubted Walmart coin was really backed 1.1? A mass rush to redeem could force Walmart to sell off billions in treasuries super fast, potentially messing up crucial funding markets.
Right.
Think back to the money market fund runs in 2008. There's operational risk too. Is the reserve actually safe? Remember when Silicon Valley Bank failed? Circle's USDC stablecoin briefly lost its dollar peg because some of its reserves were stuck there. Shows the dependencies and just concentration risk. You'd have immense financial power and risk packed into these giant firms that don't have the same supervision, the same emergency backstops like access to the Fed's discount window that banks do. It even touches on monetary policy. Could large shifts in where money is held affect how the Fed steers the economy?
Okay, let's shift to another major concern that feels, well, pretty concerning. The report warns that even if retailers break the card network's power, they might just create a new and arguably more formidable set of market gatekeepers.
Right. That's the big antitrust worry. Are we just swapping one oligopoly, the card networks, for maybe a new duopoly of Walmart and Amazon controlling this crucial payment bottleneck within their massive ecosystems, especially impacting those third-party sellers who rely on them? And this could lead to specific antitrust problems, things like tying or self-preferencing. Could Amazon give better search results or lower ad costs only to sellers who use Amazon Coin? It echoes existing complaints about their marketplace practices.
Yeah, leveraging their platform power into payments.
Exactly. Or exclusionary practices, making it hard or costly for other payment options, other digital wallets, to work well on their sites or in their stores. A bit like the fights over Apple's App Store rules, maybe, using retail dominance to lock up the new digital payment market. But maybe the risk the report calls the most profound long-term risk. That's the unprecedented concentration of data.
Why is that data angle so much bigger than what they already have? They already know a lot about us.
Think about the silos now. Walmart knows what you buy, down to the specific item. Your bank or Visa knows how much you spent and where generally. With a retailer stablecoin issuer, that one company potentially gets both, fused together. They know exactly what you bought, how much, where, plus how you paid, your real-time balance in their wallet. Maybe even who you send money to if they build peer-to-peer features.
Wow. Okay, that combination of detailed purchase data, payment data, financial behavior, that's like the holy grail for targeted ads, but it also sounds really invasive.
It is potentially incredibly powerful. It could fuel hyper-targeting, dynamic pricing, charging you more if your data suggests you can afford it, proprietary credit scores just for their ecosystem, all potentially less regulated for privacy than traditional banking data. Lawmakers worried about big tech currencies often flag exactly these privacy risks. And the most chilling point the report raises, this level of data and control could morph into a kind of de facto private social credit system. Imagine a loyalty score based not just on spending, but everything what you buy, return frequency, platform activity. Could that score dictate your access to discounts, products? Could bad behavior, like too many returns, get you penalized, maybe limit your use of their payment system? It's described as a potential powerful tool for behavioral management. Huge power.
Okay, so wrapping this all together, money, the tech, the laws, the reactions, the risks, the data, where does the report see this ultimately heading? What's the strategic outlook?
Well, the report doesn't see one system totally winning out. It's not like cards disappear overnight. Instead, this whole push is accelerating us towards a multi-rail payment future. You'll likely have traditional cards, Visa, MasterCard, still there. You'll have real-time payments like FedNow getting bigger. Digital wallets like Apple Pay is the front end. Buy now, pay later isn't going away. And if the regulation happens, potentially these retailer stablecoins. Each rail has pros and cons, right? Cost, speed, how widely it's accepted, who controls the data, regulatory hurdles, the source details that trade off. So for the players, the report offers advice. For Visa and MasterCard, double down on being that interoperability service provider. Build the bridges, the on-off ramps, security, identity layers connecting everything. Make money facilitating movement between systems. For banks, especially community banks, it's defense and offense. Lobby for those guardrails, no interest on stablecoins, limit what issuers can do, but also innovate, partner with fintechs, maybe form consortiums, really emphasize relationship banking value beyond just holding deposits. For Walmart and Amazon, the advice is go slow.
Phased approach. Maybe start with B2B payments, supplier stuff. Tokenize loyalty points first. Get the operations and compliance perfect before a big consumer launch. A failure would be disastrous for their brand and for regulators. The big task is finalizing clear federal rules. It's a tough balancing act. Encourage competition to lower costs, but ensure stability with strong, bank-like rules for issuers. And critically, prevent new monopolies and build in robust data privacy safeguards from the start.
It really feels like the decisions made now, maybe in the next year or two, will, as the report says, define the structure of American commerce and finance for decades to come.
Yeah, it's amazing how it connects everything, isn't it?
Yep.
From that extra bit you pay at the grocery store all the way up to these huge strategic battles, debates in Congress, the future of local banking. It's all tied together.
It really is. We started with just the cost of swiping a card, saw how these giant companies see billions in savings with stablecoins, unpacked the tech and the crucial role of lawmaking, looked at how the old guard's reacting, the surprising risks for smaller banks, and this potential rise of new data gatekeepers. It's a lot.
And maybe a final thought, something for you, the listener, to chew on from all this. As we move into this multi-rail world, choosing how you pay, it might become more complicated than just convenience or points. You might be making trade-offs you haven't thought much about before, like saving a bit of money versus knowing your payment method works everywhere, or ease of use versus how much of your financial life one company gets to see and control. What do you think is most important to protect, or maybe to gain, as all this evolves?
That's a really good question to think about. Thanks for walking us through all that complexity. This is a fascinating deep dive. Definitely something to keep an eye on, especially that stablecoin legislation news out of Washington. Thanks for joining us. We'll catch you on the next deep dive.